Kia ora everyone, welcome back to our next edition of Econ Talks. Gareth, we've had some pretty big announcements in the housing space in recent times. A bipartisan approach now in some senses to the housing crisis. The ruling Labour government and the National Party opposition coming forward to unveil not only a speeding up of a number of housing policies, but also making it so that we can build a lot more. I mean, it's quite exciting stuff, really, from now on, or going into next year at least, in Tier 1 cities, so our bigger urban centres, you'll be able to build up to 3 dwellings of up to 3 stories high each on a bit of land, sort of just as right across just about anywhere that you can build a house at the moment. Over time, this is going to bring a lot more buildings onto the market. I mean, is it going to fix the housing crisis?
Yeah, I mean, it's massive in terms of the potential effect it could have on building activity. The work that's been done across both the medium density standards that the government is proposing and also the national policy statement on urban development that came out last year and is going to be progressed over the next couple of years. You look at Auckland, for example, it could be adding up to 9,000 to 10,000 houses or dwellings rather being built per year within about 5 years' time. That's a lot, given that we're running at almost 20,000 dwellings a year in Auckland at the moment. We're not expecting that sort of rate of construction to be sustained. And so I think Auckland has the capacity over the medium term, at least in terms of the construction industry, to cope with that sort of demand. It's interesting with some of the other urban centres, you look at the likes of Hamilton and Wellington, and the capacity there is a lot more questionable about whether you're actually going to have the builders to do the work. Even if you're facilitating it, I don't think it's necessarily going to lead to a rapid increase in the housing supply overnight, particularly when you look outside of Auckland. And so people who are looking for this to be an immediate fix to the housing crisis we've got, look, it's great for the medium term, but I don't necessarily think it's going to cause the housing market to turn around in 2022 from some of the very strong results we've seen over the last 18 months or so.
I guess as well, though, we do still have the issues or the limitations around, say, infrastructure. Councils still don't have a lot more when it comes to providing that. Perhaps the Three Waters changes proposed might shift that. But again, that coordination of actually unlocking housing through land development also requires the right pipes and facilities and services to be provided. Doesn't look like there's any hope for a bipartisan deal in that sort of area. So we're still somewhat limited, you might say, heading forward. But as well as that, we have still got that very high building rate, of course, now over 47,000 consents put through in the last year. There's still a lot to be coming into the future. I mean, do we risk, though, starting to overbuild? Some commentators are starting to signal those risks about an oversupply in the housing market and how everything might be coming to, could come around around our ears. What is the potential for something catastrophic to be coming forward, do you think?
Yeah, certainly when you look at what net migration and population growth have done over the last 18 months with the borders being shut, we are definitely building fast enough to more than meet underlying demand now. The issue is, of course, we were underbuilding for the previous decade, so there's a heck of a lot of undersupply that we've actually got to work our way through before we think that you start to get into a position where you're oversupplying the market and talking about some of those sort of crash conditions that other commentators have mentioned. Look, the other factor I'd be looking at the moment, of course, is where interest rates are heading, and we've seen wholesale interest rates pushing up quite rapidly over the last couple of months or so, and that is flowing through into fixed mortgage rates. If you look at the sort of 1 and 2 year rates, well, the 2 year rate's up to about 3.9% now, and if you went back 6 months or so, it was probably sitting at about 2.5%. And so for anybody who's got into the market at that sort of 2.5% interest rate, there's real, I guess, concern starting for them as those interest rates roll off over the next 1 or 2 years in terms of what their servicing costs might look like. The thing that gives me a little bit of some confidence that the market is not going to crash, though, and you're not going to have a whole lot of forced sales, is that we've seen the test rates that the banks have been using in terms of their when they make their lending decisions. Those have been sitting up over 6%. And at the moment, in terms of our projections of where mortgage rates will go to, if you're talking 4.5%, yes, that's a big increase on what we've had this year and through last year, but it's still well within the realms of people being able to service that mortgage, even if they have leveraged themselves up quite highly to get into the housing market over the last year or so.
And I think as well, the banks themselves don't want to get into a position that they found themselves in after the global financial crisis. The Reserve Bank is making sure there are those strong protections as well. We know the core funding ratio is going to have to, or is going to increase next year. We know that, in fact, some of the banks themselves have been incorporating what is essentially debt to income limits on some sorts of lending. Higher LVRs have come through. So there is certainly a want and action at the moment to limit some of that higher risk lending. I guess as well, as we continue to move forward, even if we did start to meet market demand for housing, that would keep house prices at the current very, very high levels. More importantly, with all of those challenges that we've seen to house price growth projections at the moment, we still know that we've got, over 1% monthly seasonally adjusted growth in the housing market, have done for over nearly a year now. I mean, all of those numbers are showing that, yes, there is pressure building on the housing market and on where house prices grow, but so far there is no evidence in my mind that's showing any real turn yet. Perhaps a softening out or a more similar sort of increase coming forward, so it's not getting so incredibly further out of reach every month. But to say that we've sort of hit the downturn yet, I think is very, very ambitious to be making those sort of assumptions. And as we start to move forward again, if we do want to see house prices in somewhat of an affordable position, we're going to be waiting still quite a few decades, aren't we?
Yeah, that's right. I mean, we'll run the numbers. If house prices stayed where they are, and that's asking for an immediate stop to the momentum we've got at the moment, even if you had household incomes growing at the average rate that they have over the last 20 years or so, you'd be waiting until about 2035, 2036 before housing affordability got back to 2008 levels, and out to 2050 before housing affordability was at the levels we saw in 2000 prior to the housing boom that we had through that decade. So you're right, it is a very long time. Let's put numbers in a different sort of perspective. We had a 10% drop in house prices in the wake of the global financial crisis, and that was the biggest that we'd seen in living memory in New Zealand. If we had a 10% drop in house prices now, you'd be unwinding 4 months worth of some of the rises that we've seen since COVID struck. And so it's, again, going to cause hardship for a very, very small number of people, I would have thought. So, even with some sort of correction, stabilisation in the housing market, I'm not panicking about the sort of crash that has hit the headlines this week.
And I guess importantly as well, right, if you did have those smaller numbers of people that get hit by some sort of housing correction, well, if they're still paying off their house, if it's somewhere that they're living in and nothing has necessarily come through to affect their job, they shouldn't be too worried. They don't need to sell with, possible negative equity at that point, because they're having it as a home, not as an investment option. And look, let's be clear, if they are using it as an investment option, well, that's how the markets work. There is risk inherent in all of this. There's challenges abound. I think certainly what we're seeing at the moment is we are on a better path when it comes to housing outcomes in New Zealand, but we're sort of far closer still to the start line than we are to the finish line. And any real calls for things changing or things about to absolutely crash are either, pretty ambitious, or certainly in a position where the entire economy would have to be so wrecked for those conditions to be met that we'd have bigger fish to fry than just trying to sort the housing market. We'll continue to assess where this goes, maybe come back in 2037 to see if things are any more affordable and if we've got a house yet or not. But we will continue to monitor those trends, and we'll have a chat again about housing on one of our future editions of Econ Talks.